To the next standard, IFRS 7. It is about disclosures of financial instruments. So financial instruments are such important area in accounting, in business, that the standard setters thought that we need to have a comprehensive standard on disclosures. The actual standard, if you read the bare text, it runs into many pages. But we have tried to summarize the key aspects of disclosures in our notes. Okay. For a detailed version, you can always refer the bare text if you are interested. The purpose of the disclosure is to give investors, the users, adequate information. So much information they can understand the risk better, return better, and they can take a more informed decision. After the economic crisis that happened in 2008 in USA spread to other parts of the globe also, it was felt that the financial statements do not give us enough information to get an idea about the risk that the companies are taking. And by the time we get to know about such risk, it is too late. It is too late to do any damage control, because by that time the damage has been done. And with that objective, the standard on financial instruments were comprehensively revised, and this is the outcome of that comprehensive change. And the standard goes into too much of disclosures. So that is the idea behind disclosure requirement. First, I am going to explain some important terms which we are going to use in this disclosure requirement standard. What is credit risk? Credit risk means one party to a financial instrument would cause a financial loss to other party by failing to discharge the obligation. It is simply default risk. Bad debt, what we call bad debt. Okay. The risk is that one party will not be able to pay. Is it a serious risk in a business? Yes. Nowadays, so many banks are not able to recover their dues from customers. Okay, what you call net NPA, non-performing asset, because that is a credit risk. You are not able to recover, and it is going to cause loss to whom? To the banker, to the owner. Means ultimately the shareholders only, they have to take the hit. So some disclosures about credit risk will come in the later part. What disclosures you have to give, we'll discuss later. What is currency risk? Again a serious risk. Exchange fluctuation risk, which can really cause damage to an organization to a very high scale. Okay, some Indian companies had borrowed money in 2006-7, around 40 rupees was the rate of exchange. They took a 10-year loan and they had to repay it in 2016. In 2016, the exchange rate was 70. From 40 to 70 in 10 years means your liability has almost doubled. That is your exchange loss, and nothing can be done about it. So that is your exchange risk. Is interest risk also serious? What is interest rate risk? Two risks are involved here. One, the fair value of your debt instruments will change. Higher the interest rate in the market, lower the value of the bond. Many corporates, banks, NBFCs, insurance companies, they have invested in bonds worth thousands and lakhs of crores of rupees. So 0.1, 0.2% increase in the interest rate will reduce the value of their bond by several thousands of crores of rupees. So which will damage their P&L account and financial statement. Second risk is that interest rate will change, so reinvestment income also gets affected. Okay. So that is interest rate risk. Investment in debt instrument will cause such risk. One more serious risk is liquidity risk. Liquidity risk means you will not be able to pay your financial liabilities on time because you don't have enough liquid assets to pay the liabilities. You have assets, but they are not in liquid form. They have got stuck. You are not able to convert them into cash. And this is a serious risk. Many big corporates got wound up because they did not have liquidity. They did not have liquidity. They have assets, but they don't have liquidity. Creditor want payment. Is it right? And nowadays, because in the country there are so many strict regulations, so creditor immediately 1 month he'll wait and then go to the court, call for insolvency, put the chairman in the jail. This is the risk. And what is market risk? The most dangerous risk. Tomorrow, what will happen in the stock market, we don't know. You have bought shares of lakhs of crores of rupees. But do you know what will happen tomorrow in the stock market? Nobody knows. After the election, share prices may crash by 40%, 30%, and that is a loss. Something goes wrong in USA. Our stock market crashes the other day. Okay. Some terrorist attack some place, our stock market crash. That is market risk. Really, you can't do anything about it. If you have invested in financial instrument, you are exposed to this risk. Market interest rate goes up, value of bond comes down. So this risk will be divided into three types. Currency risk already covered, interest rate risk, or any other price risk. So much risk you take when you are a party to a financial instrument. Do you know that? And what is past due? Past due means financial asset is past due when a counterparty has failed to make a payment when contractually due. Like your EMI falls due on 30th June and you don't pay. So your asset becomes past due. This word is used in banking parlance. That is, your liability was not paid on the given due date, so it has become past due. So the moment it becomes past due, it is subject to risk. A debtor not paying on time, installment not received on time, means there is a risk involved now. This standard requires the entity to perform sensitivity analysis. Now, what is sensitivity analysis? What will happen? What will be the impact in the value of asset, liability, profit and loss if suppose interest rate changes by 1% or 0.5%? If you are exposed to interest rate risk, then you have to give this analysis in your notes. It is just a hypothetical calculation. You have to present that if the interest rate in the market changes by 0.5%, 1%, 1.5%, by what amount the value of your asset, liability and profit and loss will be affected. If exchange rate changes by 1 rupee, 50 paise, 10 paise, different calculation you will take, then by what amount the value of your asset, liability, income, expense will get affected, or any other such risk. Okay, so that is called sensitivity analysis. Means we are telling the investors that, dear investor, be careful. If this variable changes by so much, this is what the impact on the profit can be. Now we'll come to directly the disclosure part now. First, we will understand the disclosure related to statement of financial position, which is popularly called balance sheet. So what are the disclosure requirement in the SOFP, statement of financial position, paragraph 3? You will divide the financial assets into, that means in your financial statement, balance sheet, you have to write financial asset. Under that again, you have to write every TPL category separately. And in every TPL category also, we will divide into two. Those which are mandatorily designated as FVTPL, those are which are designated by the company, and those because of their nature are mandatorily classified as FVTPL. So FVTPL instrument will be shown in two parts. Then financial liabilities which are measured at amortized cost will be shown separately. Financial asset which are measured at amortized cost will be shown separately. And then same thing for FVT OCI instrument also. Everything is printed. FVT OCI instrument will be divided into two categories. Those which are designated as FVT OCI like equity instrument, and those which are classified into FVT OCI because they meet the requirement of FVT OCI. For example, debt instrument. If it satisfies cash flow characteristic test and business model test 2, then it goes into FVT OCI. But equity instruments are voluntarily designated by the management in FVT OCI. So you have to present separately. Okay. And financial asset at FVTPL showing separately those which are designated as FVTPL and those which are held for trading. So this is about the classification of financial asset in the SOFP. Now some specific issues we will discuss. When an entity has designated a financial asset or liability as at FVTPL, can the entity do that? Yes. Sometimes even if the asset meets the definition of FVT OCI or amortized cost, in order to avoid accounting mismatch, we voluntarily designate it as FVTPL. In that case, what are the disclosure requirement? So be careful. The question will be, if management designate an instrument as FVTPL, which otherwise could have been designated as FVT OCI or amortized cost, then disclosure requirements will be as follows. Maximum exposure to credit risk. What is credit risk? We have understood. That means risk of default. Let the user know how much can be the maximum loss here and the amount by which any related credit derivative or other similar instrument mitigate that maximum exposure to credit risk. Now this means if you have used any risk hedging instrument, then to what extent your credit risk is reduced will be disclosed. If you have a credit risk, you will take insurance, you will take some derivative. And point number 3, amount of changes during the period. In your note I have corrected during the period and cumulatively. Amount of change during the period means this year. Cumulative means from the inception till the end of this year in the fair value of financial asset attributable to changes in credit risk and attributable to changes in the amount of change in fair value of any related credit derivative. So you have to disclose these 3 disclosures for which instrument? Those instrument which you have categorized as FVTPL, which otherwise could have been categorized as FVT OCI or amortized cost. Now, where an instrument entity has designated a financial liability as FVTPL, that is also possible. Why will an entity designate a financial liability at FVTPL? Same reason, to avoid, fill in the blanks, accounting mismatch. Then for such financial liability, 2 disclosures. It shall disclose the amount of change during the period and cumulative change from the beginning till today, and only for this year the fair value of such liability which is attributable due to change in credit risk, and also the difference between the carrying amount of financial liability and the contractual liability of the entity. This you have to disclose. How much change is due to change in credit risk? Fair value has changed. One of the reasons for change in fair value is credit risk. So you have to quantify the effect of change in credit risk and the difference between your book value and your contracted value, because book value can be different from contracted value. Book value, you are following fair value accounting. Contracted value means what you are going to pay for. Where an entity has designated investment in equity instrument to be measured at FVTOCI. Do you remember? In case of long-term strategic equity investment, normally the management will say OCI equity, because my intention is not to trade or sell those instruments. Then the disclosure requirements are: it shall disclose that the investment have been designated. Reason for this presentation alternative: why? Fair value at the end of reporting period. Dividend recognized on such instrument. Showing separately amount from investment derecognized during the period. That means dividend from those equity which have been derecognized and dividend from those equity which are still held on the reporting period. Any transfer of cumulative gain or loss within the equity. If an instrument is an equity instrument designated as FVTOCI, then you have learned everything that you have learned is now coming in one place. On derecognition, the balance lying in equity OCI account is retransferred to another equity account, but not to P&L account. That you have to disclose. Now, what about the rule for reclassification? Rule for reclassification we have seen in IFRS 9. What about the disclosure requirement for reclassified assets? Date of reclassification. Then detailed explanation. Why you have reclassified? So you have to justify that during the year there is a change in business model, and then you have to give the effect on financial statement. The amount reclassified into and out of each category. So how much FVTPL was reclassified into FVTOCI or amortized cost? How much FVTOCI was classified into FVTPL? How much amortized cost was classified into FVTPL? So all those reclassification in and out of a category will have to be disclosed. For a financial asset classified out of FVTOCI, the fair value of the financial asset at the end of the reporting period and the fair value gain or loss that would have been recognized if the reclassification had not been done. So if you are reclassifying out of FVT OCI to other category, then you have to disclose how much is the fair value gain or loss that would have been recognized if you would not have done the reclassification. And for financial asset reclassified out of FVTPL, that means we have shifted from FVTPL to other two category, then in that case, for each reporting period after reclassification, for financial asset classified out of FVTPL, effective interest rate determined on the date of reclassification and the interest revenue recognized. From FVTPL, where we will move? We'll move to either amortized cost or FVT OCI. In both cases, you have to apply effective interest rate method. So if you remember logic, you will be able to remember the disclosure. Otherwise, too difficult to remember this disclosure. So effective interest rate is used when an instrument is either amortized cost or FVT OCI. So disclose that. And then how much interest revenue you have recognized. Now entities shall also make disclosure of the following: carrying amount of financial asset in respect of which lien or other encumbrances have been created, and the terms and condition of such pledge or lien. So if you have given asset for pledge purpose, or you have given it as a security, give disclosures. Many companies, in India, they pledge their share to borrow money from bank, give disclosure. Let the investor know that so much investment has been pledged. And then a reconciliation of the change in the allowance account. What is allowance account? Loss allowance, impairment loss allowance. We have taken some questions on that. So loss allowance account at the beginning, plus minus in that account, and closing balance. That is called reconciliation of change in loss allowance. Where impairment loss is accounted for separately rather than adjusting the carrying amount directly. So instead of directly reducing debtor account, what we do here, we pass an entry. We have done that. P&L account debit to loss allowance account. And again at the end of the year, we'll do the calculation. Every year we'll do the calculation. So you have to reconcile the opening and closing balance of loss allowance account. Then existence of special feature in financial instrument, such as a compound instrument with multiple embedded derivative whose values are interdependent. Now write here example, callable convertible bond. Now some companies issue some compound instrument which is already a complicated instrument, and to make it more complicated they add some more embedded derivative into it. In this case, because it's a complicated derivative product, they are asking you to give details about the existence of special feature in this instrument. Because many times the investor don't know exactly what is this instrument, what is the impact on the risk and return. Tomorrow what will happen to me because of this instrument? Let me know that. Give disclosure about such instrument. And then you have to give disclosure about defaults and breaches in loans payable. Now we'll come to disclosure requirement relating to total comprehensive income, which means profit and loss. So here we have to give disclosure about net gain or loss. What are the net gain or loss possible in this chapter? Mostly those instruments which are measured at fair value, their change in fair value goes through P&L account, like FVTPL instrument, asset, FVTPL liability. And you have to give separate disclosure for designated instrument and mandatory instrument. Then in case of financial asset measured at amortized cost, gain or loss, when you derecognize them. Financial liability measured at amortized cost, again gain or loss. Investment in equity instrument designated as FVT OCI. Again this gain or loss will be shown in OCI section, and financial asset at FVT OCI. So all fair value change, all gain or loss on sale will be appearing here. Next is total interest income, total interest expense. So you have to visualize what are the items relating to financial asset. One is your fair value change. Second is interest income, interest expense, dividend income, then gain or loss on derecognition, and then fees income. Sometimes you receive fees or fees expenses on financial asset or liabilities. Analysis of gain or loss recognized in statement of profit or loss arising from derecognition of financial asset measured at amortized cost. So that you will disclose separately, gain or loss arising due to derecognition of financial asset measured at amortized cost. And now come to the last part, other disclosures. In other disclosure, one, you will disclose all your accounting policy related to financial instrument. I have written very briefly here, just one line. Actual disclosure is little more. Like for example, you will disclose accounting policy, measurement basis, etc. in case if you are following hedge accounting, which is a option you can choose but subject to certain condition, then you have to disclose for hedge accounting nature, description of each hedge, instrument designated as hedging instrument, nature of risk being hedged. All this we discussed earlier also, but now it also comes in your notes to account. The users also get to see all these disclosures. In case of cash flow hedge, disclose timing of expected cash flow and timing when these are likely to affect the P&L account. We have solved today many questions. In case of fair value hedge, gain or loss in respect of hedging instrument and the hedged item. Fair value of each class of financial asset and liabilities in a manner that it permits a comparison with carrying amount. To give disclosure in such a manner, you can easily compare carrying amount with fair value. Method and valuation technique adopted in estimating fair value will also be disclosed. That means you have to actually give so much information to the investor. What method I have used to calculate the fair value. Not only that, you have to disclose the nature and risk arising from financial instrument in such a manner that it will enable the users to evaluate the nature and risk arising from financial instrument to which the entity is exposed at the reporting date. And these disclosures will be given under two headings: qualitative disclosure and quantitative disclosure. Qualitative means narration, description, and quantitative means numbers, statistics, facts and figures, okay, analysis. So that is called qualitative. So qualitative means narrative disclosures using long paragraphs, explanations, like you will disclose entities' exposure to risk, how they arise, entities' objective, policy and process for managing the risk and the method used to measure the risk. So these two you will disclose. If during the year there is any change in this or this A or B, then that will be disclosed. And what about quantitative disclosure? Quantitative disclosure means numerical information so that the user can understand the impact of narrative description. So qualitative will be converted into quantitative. The method used for managing risk should be disclosed as a part of accounting policy. The quantitative information disclosed should be based on the information provided internally to the key management personnel. That means what information the KMP gets to see. You as an investor will also get a information which management looks at, because finally it is your company. You are the investor. You have put your hard-earned money. You have all the right to know all the information which affects your risk. Okay. So that is why so much disclosure. You may not like it as a student, but this is required to understand the risk. Billions of dollars are put into a company by companies nowadays. Is it right? So you have to know the risk. Now we'll see what are the disclosures relating to credit risk. So if a specific question is asked, write down about 4 or 5 points. So that is why I have just written 4 or 5 points for every heading. If you want to read in detail, refer the bare text which runs into 30-40 pages. Now, next line. Maximum exposure to credit risk at the reporting date without considering collateral held or any other credit enhancement. Collateral means, suppose you have a debtor of 30 crore and you have a collateral of 15 crore. So first you disclose gross amount only, 30 crore. Or credit enhancement means again method used to reduce the risk. Credit enhancement means what method you have used to reduce the risk. It's like derivative or any other contract which reduces the risk. Description of collateral held, so that if the customer defaults, how much money I can recover from that collateral or any other credit enhancement. Then credit quality of financial asset that are not impaired and not past due. So these are basically good quality financial asset. So management has to write a note about their credit quality. And carrying amount of financial asset whose terms have been renegotiated, which otherwise have been impaired or past due. So these are the disclosures for credit risk. But I have edited a lot, only the main 4 or 5 points I have noted. Then financial assets that are past due or impaired, means they have not paid on time. NPAs, what we call net non-performing asset, those who are delaying the payment, whose due date have expired. An analysis of age of financial asset, aging analysis that are past due and not impaired on enhancement are obtained. In case you have guarantee, nature and carrying guarantee amount of such financial or non-financial asset, and whether they are readily convertible into cash, as also the policy for disposing it should be disclosed. So this is about financial asset which are past due or impaired. Now what about disclosure relating to liquidity risk? So liquidity risk means not able to pay the dues on time by either you or by the other party. So in this case they are saying give a maturity analysis of non-derivative financial liability that shows the remaining contractual maturity. What are your liabilities when they will become due? So this will help me to understand the risk. Suppose a liability of 50 crore is becoming due next year. Do I have so much of cash? Maturity analysis of derivative financial liability showing remaining contractual maturities. And description on management of liquidity risk should be disclosed. Okay. Liquidity risk is very serious. And even a serious risk is market risk. What will happen in the market tomorrow, we don't know. So we have to do the analysis also. So market risk you have to disclose by giving sensitivity analysis. What is sensitivity analysis? If a variable changes by some percentage or some rupees, how it will affect the value of asset or liability, how it will affect the profit and loss. For example, if interest rate increases by say 0.5%, 1%, by how much amount your financial asset will change and P&L account. Exchange rate, if exchange rate changes by 50 paise per dollar, by what amount my asset, liability, income, expense would change, or any other price risk. And then the method and assumption that were used in preparation of sensitivity analysis, any change from previous period, and the reason for such change should be disclosed. Today you do one homework. I have given you two disclosures. Very interesting example, not from your ICAI module, but from the IFRS committee example. Okay, that how will you give disclosure when interest rates are expected to change, and how will you give disclosure when foreign exchange rate is expected to change. So this is a sensitivity analysis, and it clearly shows if the rate of exchange changes by 10% against the dollar, by what amount your profit and loss and other variables will get affected. So this standard is over. What are the main differences between IFRS 7 and Ind AS 107? Three differences, but not very significant difference. Therefore, it is written not resulting in carve out. First difference, in Ind AS only one statement is prepared, statement of profit and loss. Part 1 is profit and loss, part 2 is other comprehensive income. But IFRS standard gives you two options, either a single statement format like Ind AS, or two statement format. Two statement format means one format for only profit and loss and the second format for OCI. But that is not a major difference, it's just a format. Second difference is again not a significant one. In this chapter and in all financial instrument chapter, I have used the word statement of financial position, total comprehensive income statement. Ind AS uses the term balance sheet and statement of profit and loss. And then the third is IFRS 7 gives transitional provision also. Transitional provision means when the standard becomes applicable for the first time. Ind AS does not have transitional provision. Sir, why? Because all transitional provisions have been incorporated in Ind AS 101. So all three differences are very minor differences. Will not affect your answer. Any of the question that you have solved will not be affected. Oh, this chapter is over.